So every cloud's got a silver lining. No, 2018 wasn't a great year for investors. Most of the things you invested in, you lost money with. So if you were a China bull, then you lost around 25-26% on China shares last year. If the MSCI World Index lost nearly 10%, FTSE was down, US shares were down, bonds didn't do great, gold was down, oil was down nearly 20%. So even if you switched to commodities, it wasn't particularly safe. So in that context, the fact that we outperformed, even though we still lost a bit of money for clients. Now, the silver lining is that when you get the adjustment in prices, very often the fundamentals improved. And that's what started to happen. And that's why we've started to rebuild our equity exposures in the multi-asset funds. Well, the type of fundamentals I'm talking about are those metrics that give an indication as to whether an asset is over or underpriced by its historical trends. So at the start of the year, when everything was generally positive and people were positive about the US economy and positive about employment and expecting that a deal would be done around Brexit and it would all be sorted out, we entered 2018 in generally a good mood. Not us specifically, actually we were quite cautious through 2018, but investors throughout the globe were generally bullish going into January last year. And that meant that things like your price earnings ratio, which gives you an idea of how much investors are paying for every $1 of profit, were high. With prices falling back, and because companies generally have not been seeing a big deterioration in their profits across the board, price earnings ratios for US shares are now below their 25-year average. That makes them a better prospect for the longer term. And as equities are still delivering a better expected return than bonds, we expect them to outperform in the medium to long term. Well, with regards to sectors, we're still quite nervous about emerging markets. I think the amount of debt in China is a worry to investors around the world. Some emerging markets actually did quite well in 2018. The election of Bolsonaro in Brazil gave the market a much needed boost, and they returned positive for equity investors. But that's a one-off, and you don't know whether that can be repeated. If the dollar remains strong, emerging markets that generally borrow in dollars, so they're having to convert over their domestic currencies to pay their debts back, do particularly badly. And that's a fear. So we've looked short term to start to rebuild some of that equity exposure in the more developed markets. We think UK shares are probably undervalued due to all the worries about Brexit, but we think US shares are about fair to reasonable value now. And that's where we will concentrate, because we can control the risks more in those areas than we can by going down to emerging markets and into the small cap sectors around the globe. So is Brexit moving forward? Well, you tell me. We've got till the 29th of March to sort out a deal. But there's one underlying problem here. 52% of the electorate, those that went to the polls, voted to leave. Politicians claim that they know what those 52% wanted, but I guarantee they don't. Some of those 52% wanting to leave simply to control our borders and stay part of the customs union. Some of those 52% wanting to leave and have nothing to do with the EU completely. Some of those 52% wanted us to abolish all tariffs on imported goods. Some of those 52% wanted us to put more tariffs on foreign goods. So nobody speaks for that 52% because we didn't ask them exactly what they wanted. So the politicians make it up as they go along. In the end, I suspect that a deal will be struck of some sort. You may get an extension to the deadline for Article 50, but I suspect we won't crash out. And I think the main reasons for that are that the UK economy is weakening, the German economy is weakening, the French economy is weakening, and it makes no sense for the economies on both sides of the English Channel to muck up an agreement and fall into a complete mess of an exit when it will damage everybody. And that is probably the key factor that will mean that some deal is done. If that happens, if the deal is good, the pound will bounce, and it will be very good for smaller UK companies, which took a pasting last year. So if you look at how the FTSE 250 did compared to the FTSE 100, smaller companies in the UK, which rely more on the domestic economy, did badly. They will bounce, and we are quite well set to take advantage of that.